Many investors make the mistake of building retirement plans on math that no longer works. And the scary part is you don't even realize it until it's too late. Think about this. In the mid-90s, the typical American home cost about $120,000. And today, it's over $420,000. Healthcare spending per person has jumped from under $4,000 to more than $13,000. A $20 grocery basket in 1990 would cost you roughly $45 today. Now, let's look at income. Since the mid-90s, real median household income has risen only about 30% after inflation. And that is real growth, but it's not kept up with housing, healthcare, and food. Retirement savings tell an even tougher story. The typical American aged 55 to 64 has around $88,000 in a 401k, or about $185,000 across all accounts. In Canada, median RRSP balances hover around $100,000 to $150,000 US equivalent. Averages look better, but they are skewed. The median is reality. At the same time, retirement itself lasts longer. In 1995, life expectancy was around 76. Today, many people live into their late 80s. Costs have surged, lifespans have stretched, and safe returns have shrunk. In the 90s, you could earn around 5% in a savings account, and 10-year treasuries actually paid 6 to 8% at peak. An 8% return doubled your money every 9 years. This was called the Rule of 72. Today, that kind of safe compounding is rare. That old retirement formula relied on conservative assets doing the heavy lifting for you. It doesn't work the same way today. I'm not saying this as an outsider. I actually retired from my government analyst job in 2015, and since then I've had to make sure I have enough money to last decades. These investments have a job. They must protect my purchasing power for decades. And when you line up numbers honestly, the biggest risk in retirement isn't volatility, it's stagnation. So in this video, I'm going to walk through the 6-theme framework that I'm building my retirement around and some positions in each one so that you can see examples. Each one protects against a specific way a portfolio can collapse. And the real value is not the tickers, it's the structure. Once you understand the roles, you can actually swap in your own picks and still build something very durable over the years. Now, before we dive in, please remember, this is not financial advice, it's just how cash works. Please also click the subscribe button or the like button if you like these types of financial breakdowns and deep dive research. Okay, so let's get started. 6 themes, each one defending against a different long-term threat. So theme 1 is dominant tech infrastructure. This isn't about owning some flashy tech stock that's getting attention right now. It's about owning the digital backbone that the economy already depends on. Every decade, a few companies become so deeply embedded into how businesses operate that they stop feeling optional. They become part of the foundation. Removing them isn't a simple decision. It's usually expensive, risky, and disruptive. And that's where Microsoft sits today. I want a company that benefits from the entire digital economy expanding, not just one trend like AI or cloud software. I want something that businesses continue paying for regardless of which specific technology cycle is hot right now. Most large organizations already run on Microsoft in ways people don't fully think about. Windows, Office, Azure, identity systems, developer tools. These aren't side tools. They are core infrastructure. Replacing Microsoft isn't a software upgrade. It's a full operational overhaul. And the numbers show how large this has actually become. Azure grew 39% year over year in Q2 fiscal 2026. Microsoft Cloud generated over $51.5 billion in a single quarter. Their commercial backlog sits around $625 billion. Copilot already has more than 15 million paid users. The bull case is simple. Microsoft doesn't need to win AI completely. It benefits as long as AI adoption continues because Azure is where a meaningful portion of that compute happens. Every AI workload strengthens their position. And the deeper companies build on Azure, the harder it becomes to move away. Azure demand is currently exceeding capacity. Microsoft has already admitted that they can't fulfill every single AI workload request yet. And that sounds bullish, and it is. but it also means that massive spending is coming. Capital expenditures reached nearly $35 billion in a single quarter. That's expansion. They're building ahead of demand. The bear case isn't that Microsoft fails. The risk is slower returns on that investment if demand doesn't grow as quickly as expected. If the economy becomes more digital over the next 20 years, Microsoft is one of the companies positioned at the center of the ship. Now, a close second, Amazon, belongs in this category too. AWS plays a similar role, and many companies depend on it the same way enterprises depend on Azure. Microsoft gets the edge for me because of how deeply integrated it is across the full enterprise stack. But Amazon is absolutely part of the same infrastructure layer, and I do own both. The next slot is healthcare, and I've chosen Lilly in my portfolio. This slot benefits from an aging population and pricing power that doesn't depend on economic cycles. Healthcare spending rises regardless of economic cycles, and that makes companies with pricing power in healthcare structurally defensive. Lilly's breakthrough diabetes and obesity treatments became the best-selling drug franchise in the world in the third quarter of 2025, generating over $10 billion in a single quarter. And just a year earlier, that number was about $4.3 billion. That's more than doubling in 12 months. Total company revenue grew 54% year over year, driven largely by demand for these treatments. And this isn't a short-term spike. The global obesity treatment market is projected to reach around $150 billion over the next decade, and Lilly is already one of the dominant players. They're also expanding access. Starting in 2026, Lilly reached an agreement to provide its obesity treatments to Medicare patients at about $50 per month, opening the door to millions of new users. On top of that, Lilly has a new once-daily obesity pill currently under FDA review, and analysts estimate that this pill alone could generate up to $16 billion annually. Lilly is positioned at the center of one of the largest new pharmaceutical markets in decades. The bear case here is a lot of this success is already reflected in the stock price. The market knows Lilly is leading in one of the biggest pharmaceutical opportunities in decades, and expectations are high. And like all pharmaceutical companies, Lilly depends heavily on its pipeline, and when expectations are high, even one delayed approval or disappointing trial can trigger a sharp reaction in the stock. Close second in this one is Pfizer. Pfizer also fits this category, but for a different reason. It's trading at a lower valuation, and its pipeline is in the early stages of recovery after the post-pandemic slowdown. Now, the difference is momentum. Lilly is currently driving one of the fastest growth cycles in the industry, while Pfizer's growth story is still rebuilding. Slot number 3 is consumer staples. Now, this slot is not about excitement, it's about stability. And when the economy slows down, when markets correct, when confidence drops, people still buy certain things. They still buy groceries and household essentials, and they still renew memberships that save them money. Costco's strength clearly shows up in the financials. Net sales reached nearly $270 billion in 2025, up from $249 billion the year before, while comparable sales still grew 6% even at that massive scale. Membership fee revenue, which is the most stable and profitable part of the business, increased 10% year over year to over $5.3 billion, driven by both new members and price increases. Even more importantly, renewal rates remain extremely high at 92.3% in the US and Canada, meaning the vast majority of members continue paying year after year. Costco also continues expanding its footprint, adding new warehouses and growing its global membership base, which reached over 81 million paid members and more than 145 million total cardholders. Costco's edge is that the membership fees create a profit stream that doesn't depend on retail margins. Now, the bear case here is that it's not cheap. Costco is currently at a 54 trailing PE, and that premium reflects durability, and investors are paying for stability, not explosive growth here. It's also still a retailer, and if consumer demand weakens sharply, short-term earnings can soften, but the risk here is not collapse. It's slower growth than the market expects. So a close second in this one is Procter & Gamble. If you want even more defensive positioning, Procter & Gamble works here with a current PE near 24. It owns brands people use daily, pricing power is embedded, and it's less cyclical than retail. And Costco gets the edge because of its membership model and growth runway. Slot number 4 is the financial compounder. In this case, I'm choosing Visa. This slot is about owning the financial plumbing of the global economy. Not a bank, not a speculative fintech, a toll booth. Every time money moves electronically, Visa takes a small percentage of it. It doesn't lend the money. It doesn't take credit risk. It simply runs the network that connects buyers and sellers. Visa is already operating at enormous scale. In its latest quarter, Visa generated $10.9 billion in revenue, which is up 15% year over year, with $5.9 billion in net income and $6.1 billion on a non-GAAP basis. Payments volume grew 8%, cross-border volume grew 12%, and Visa processed $69.4 billion in transactions in just one quarter. It scales without taking balance sheet risk because Visa's costs grow much slower than its revenue, and a large portion of each additional dollar becomes profit. Operating margins are extremely high because Visa doesn't need factories, inventory, or large capital investments to grow. It needs network volume, and that network becomes more valuable the more it's used. The bull case is that Visa compounds alongside the global economy. It wins when people spend more, when prices rise, and when more commerce moves digital, and also when emerging markets modernize. Even at its size, Visa is still growing revenue double digits, and earnings per share grew 15% year over year last quarter. This is one of the cleanest compounding machines in the financial system. Now, the bear case, of course, is that Visa is not immune to economic slowdowns, and if consumer spending drops sharply, transaction volumes slow. A close second is Berkshire Hathaway. If Visa is the financial toll booth, Berkshire is the diversified capital allocator. Berkshire owns insurance companies, railroads, utilities, manufacturing, businesses, and a massive equity portfolio. Slot 5 is Energy Infrastructure Scarcity, and I've chosen Constellation Energy. This slot is about owning physical infrastructure that becomes more valuable as electricity demand rises. Constellation operates the largest nuclear fleet in the United States with 21 reactors. Nuclear is critical because it delivers reliable 24/7 baseload power, and demand is already showing up in contracts. Microsoft signed a 20-year agreement to restart 3 Mile Island, and Meta signed a 20-year deal for 1.1 gigawatts of nuclear power starting in 2027. Constellation's nuclear fleet is running at extremely high utilization, hitting a 98.8% capacity factor in 2025, and that tells you demand isn't theory, the system is already tight. The bull case here is that AI is fundamentally an electricity problem. Data centers require constant, uninterrupted power, and nuclear provides that. Constellation owns scarce assets that cannot be easily replicated, and long-term contracts lock in predictable cash flow for decades. And as electricity demand rises, these assets become more valuable. The bear case here is that revenue is becoming more dependent on large tech customers. Now, a close second here is NextEra Energy. NextEra is more diversified with nuclear, wind, solar, and regulated utilities. It's more stable, but with less direct exposure to nuclear scarcity. Next up is slot 6, which is the wild card. In this case, we're choosing Rocket Lab. This slot protects against being completely wrong about the future. It's about ensuring that your portfolio has exposure to future industries that don't fully exist yet. Rocket Lab generated $144 million in Q2 of 2025. Revenue growth is being driven by launches, spacecraft systems, and defense contracts. Now, this isn't just a rocket company. It builds rockets, satellites, and space infrastructure. The bull case is simple. Rocket Lab is positioning itself as a full-stack space infrastructure. They already launch regularly, they have defense contracts, and they're expanding into larger launch vehicles. And if Neutron succeeds, the company moves into an entirely different revenue tier. This is one of the few companies outside SpaceX with real launch capability. Now, the bear case here is that Rocket Lab is not profitable yet, very close. Neutron delays, launch failures, or competition from SpaceX could also slow growth. And this is the highest risk slot in the portfolio, but it's also the one with the most asymmetric upside. Now, a close second here is SoFi. SoFi has strong growth and a banking license, but operates in a far more competitive and crowded industry. And Rocket Lab gets the edge because it operates in a scarcer, harder to replicate market. This is a concentrated framework. These stocks will correct. Some might drop 30% at some point. Now that's normal. And the compounding only works if you stay invested long enough for the business to grow underneath the volatility. Now, before we close, let's address a few obvious things. First of all, dividends. Some of the companies in this framework do return capital. Microsoft pays a growing dividend, Visa does as well. Costco pays a dividend and occasionally special dividends. Berkshire returns capital through buybacks. So income is part of the equation, but the primary engine here in this setup is earnings growth over time. And if income is your main goal, check out my other video on high-paying dividend ETFs. It's much more detailed. Second is diversification. This video isn't suggesting you retire with only 6 stocks. In a real portfolio, these would sit alongside ETFs and additional holdings across the same themes. The ETF gives you broad exposure, and the individual companies give you targeted compounding and growth. Because what this framework really represents are themes: technology infrastructure, healthcare demand, consumer durability, financial infrastructure, energy scarcity, and asymmetric upside tied to the future. These are long-term forces that are likely to shape the economy for decades. Now, to be clear, I am not building this as theory. This is how I think about protecting my own retirement. Every one of these companies might correct at some point, and some will drop 20 or 30%. And that's normal, and that's what matters. Now, before you leave, please share your comments down below as to what your themes are in your retirement portfolio. Also, don't forget to subscribe to the channel. Click the bell icon for notifications if you like these types of breakdowns. And thank you for watching. We'll see you in the next video.